First, some breaking news. The Commonwealth Bank is the first bank to act on the RBA's rate rise, lifting home loan variable interest rates by 0.25%. So, Ross Greenwood, welcome to you. What's your reaction to this, first of all?
Well, the Commonwealth Bank is the first and also the biggest home lender in this country. So by it raising interest rates by 0.25%, it gives a pretty good guide as just about what every other lending institution in the country is going to do. But it also really, if you like, reinforces the fact that homeowners are the ones who are going to pay for this rate rise by the Reserve Bank today, which has come much, much earlier than what had previously been saying to people, even as late as last year when the Reserve Bank governor said he couldn't understand why money markets were pricing in interest rate rises this year, and that really he couldn't see that the first rate rises were until late 23 or early 24. And so from that point of view, I would suggest that there would be many homeowners tonight who'd be disappointed in these rate rises. So what we can see here is the Commonwealth Bank, its variable rate is really no reflection of what people should be paying. They right now should be paying, with one phone call, literally 2% for their mortgage, but they've raised them by 0.25%, which basically means this is the first of not just one, Erin, but many interest rate rises that are coming. So even today, in his press conference, the governor of the Reserve Bank, Philip Lowe, gave a strong indication that the normalised interest rates, in his opinion, were somewhere around 2.5%, which means even from here, there could be another 9 interest rate rises coming out until the middle of next year. So mortgage holders in particular, business especially as well, really have to understand that their cost of money, their cost of borrowing is rising and going to continue to rise into the foreseeable future.
Speaking of those people impacted, Ross, our viewers here are obviously highly intelligent, very well educated, of course. But put it simply, what does this actually mean for everyday Aussies?
Well, give you a small example. A typical mortgage in Australia is $800,000. So a rise of even 0.25% is about $1,250 a month for those people. But then you take that over the course of the year, and that $800,000 mortgage, if these rate rises do continue, 7 of them this year, and really each one of those adds up, it's the best part of $16,000 a year that those people are going to have to pay extra compared with what they're paying now. Now, this is especially going to hurt people who have recently bought properties or recently borrowed money for business. The reality is that most people who have had homes for a long time are going to be less impacted by this because they'll have built buffers and should have built buffers while interest rates were very low. Those who are going to be most exposed are those who have gone and bought multiple properties as investments and really with really low deposits, and certainly first home buyers as well who have recently bought with relatively low deposits. They're the ones who are most at risk as a result of these rate rises, and they're the ones who you're going to hear the stories about into the future who are really going to struggle potentially to cope if the rate rises, the rates rise as much as what the money markets say they will.
Yeah, it's not ideal for them, but do you think this was inevitable, obviously? Were the RBA too slow to act?
The Reserve Bank was no doubt too slow to act. It somehow thought that Australia was different to other parts of the world, different to the United States, different to the UK, different to New Zealand, different to Singapore, different to Korea, different to all those places that had said they had inflation coming. And as a result, they had to put up their interest rates earlier to head it off. But as I say, late last year, our central bank governor was saying, no, Australia is a different case. We have different wages outlooks. We have different, if you like, policies in place. We will not have to increase interest rates as much as they have overseas. Well, that's now proven not to be true, that Australia is almost in an identical position. And though the Reserve Bank governor could not have foreshadowed a war in Ukraine, he could not have foreshadowed the very harsh lockdowns in China right now, which certainly have affected prices and supply lines. The reality is that Australia, it turns out, is absolutely no different to the rest of the world.
Yeah, funny that. What does this mean for inflation and cost of living?
Well, it only adds to the cost of living, doesn't it? So if you think about this, and it even comes to wages pressures, because if a person now is facing these interest rate rises, and there are multiple interest rate rises to come, their costs are rising. So they're going to have to cut back somewhere. But the problem is that prices are rising in supermarkets. Prices are rising when you want to change the tyres on your car. Prices are rising when you want to take your kids and kit them out for sport. So this is the reality of where Australians face a crimping of their standard of living. So something's got to give somewhere. Now, that could either be the savings, if they have them in their bank accounts, Because remember, of the $350 billion that the government handed out as part of JobKeeper, the Treasurer estimates that $250 billion of that is now in Australians' bank savings accounts or in their mortgages. They've got ahead with their mortgages, so maybe they have to actually chip into some of that to actually make ends meet or make their lifestyle meet. So the problem of it is that there are some who aren't going to be able to do that. And so for them, life is going to get tougher. And this is what happens when interest rates rise. But as you point out, people should have acknowledged that interest rates were at the emergency all-time record lows and they could not stay there forever. And so from that point of view, people should have prepared. Will have they all prepared? Of course they won't have, but they should have prepared because those interest rates, as low as they were never going to last forever.
Yeah, it was unsustainable, wasn't it? Now, finally, the Victorian Treasurer delivered the state budget this afternoon, a blowout of over $17 billion. Victorian Premier Dan Andrews has promised a big health boost, but can they actually afford it?
Well, here's the interesting thing. So you've got a blowout in the budget, and Tim Pallas, the Treasurer there, and the Premier have basically said, look, we don't believe in austerity. We don't believe that we need to cut. We're going to spend. We're going to get Victoria's economy strong by spending. And the areas where certainly COVID has exposed gaps is in the healthcare system, but there'll be money for schools, money for transport and obviously infrastructure as well. But the one point to note is while interest rates are rising, all of this spending leads to more government debt in Victoria. So this year just finished, the debt in Victoria was some $70 billion, but by 24-25, so just basically 3-4 years later, the debt will reach around $170 billion in Victoria. So in other words, that spending is really going to ultimately end up with more debt for Victorian taxpayers long term.
Yeah, it's eye-watering. Ross Greenwood, thank you so much for your brilliant analysis as always.
Quite okay.